You want to make sure that no one makes off with your hard-earned investment money? Stick around, and I'll tell you how.
Jailbird, jailbird, you got a big surprise.
This episode of the History Lessons podcast is sponsored by Victory Independent Planning. Hey, are you ready to take the stress out of your retirement? At Victory Independent Planning, we put you on the right trajectory with our exclusive VIP Retirement Glidepath. Our smart approach prepares you for what's next by optimizing your sources of savings and income, your medical and healthcare planning, your advanced estate and giving strategies, risk management and investing, and tax planning. Let us help you glide into retirement with confidence. Text Glidepath to 239-567-5477. That's Glidepath, all one word, small letter G, to 239-567-5477, and receive a link to schedule a complimentary consultation. Do it today to start your journey on the VIP Retirement Glidepath, because your future deserves a safe landing. On December 11th, 2008, Bernard Madoff was arrested for orchestrating the largest Ponzi scheme in history, involving billions of dollars and spanning several decades.
I am painfully aware that I have deeply hurt many, many people.
Bernie Madoff, a former chairman of NASDAQ, founded Bernard Madoff Investment Securities, LLC in 1960. The firm was renowned for providing steady and consistent investment returns, attracting wealthy individuals, charitable organizations, and institutional investors. But by the 1990s, suspicions about Madoff's business practices began circulating. Experts questioned the lack of transparency and the improbability of his consistent returns. But his status in the financial world helped deflect most of that scrutiny. Madoff's operation was a classic Ponzi scheme where returns to existing investors were paid using funds from new investors rather than legitimate profits. Investors were promised high, stable returns, which he achieved by falsifying account statements. He claimed to use a split strike conversion, quote, end quote, strategy, a legitimate investment technique, but no actual trading ever occurred. To maintain the illusion, Madoff used feeder funds, intermediaries that funneled client money into his operation, helping him access vast amounts of global capital. The 2008 global financial crisis led to significant withdrawal requests, which Madoff's scheme couldn't meet because it lacked actual funds. On December 10th, 2008, Madoff confessed to his sons that his business was, quote,
one big lie,
end quote. They reported him to authorities, and he was arrested the following day.
As the years went by, I realized that my arrest and this day would inevitably come.
In March 2009, Madoff pleaded guilty to 11 federal felonies, including fraud, money laundering, and theft. He was sentenced to 150 years in prison. In all, the scheme defrauded approximately $65 billion from thousands of clients, though the actual losses, net cash invested, were closer to $18 billion. A court-appointed trustee has worked to recover funds for victims, retrieving over $14 billion as of recent years. Bernie Madoff died in prison in April 2021. Here then are 4 lessons for the modern investor from Bernie Madoff's Ponzi scheme. Number 1, beware your cognitive biases. Madoff used investor psychology as a weapon against his victims. For instance, the hot hand fallacy. Madoff supposedly had perfect market timing ability, going to 100% cash before market declines in 1998 and 1999. Even if true, which it wasn't, it wouldn't mean that he was more likely to do it again. That is the hot hand fallacy. Also, recency bias. According to one source, a Madoff fund returned 10.5% consistently for 17 years. Investors believed, despite common sense, that such performance would continue to happen. And then there's confirmation bias. Clients would call to complain that Madoff promised 18%, but they'd only gotten 16%. All of a sudden, an amended statement showing the promised rate would appear soon after. Investors were looking for information to confirm what a great investment they had made, and they avoided the obvious non-conforming data. And the bandwagon effect. Steven Spielberg, Sandy Koufax, Larry King, Kevin Bacon, and John Malkovich all invested with Madoff. Why form your own ideas when others have already been sold? Your brain is not your ally in this struggle in the investment world. Indeed, there are days when your own brain will be your worst enemy. So heed those warning signs. Lesson number 2, understand economic basics. Madoff's purported returns violated several rules of basic economics. First of all, technology. Yes, technology leads to progress, and Madoff pioneered electronic trading. Yet, no one at his firm had an email account, lest it leave an electronic trail. Also, business cycles. Cyclical downturns occurred throughout Madoff's investing history, including recessions in 1991 and 2001. But his funds managed to post positive returns during both periods. How? No one had any idea. He didn't allow outside performance audits. Economic data is important and widely misused. Understand the basics and don't waste time on the minutia. Lesson 3, know investment and market limitations. Madoff had no bad years. So cue the ominous alarm bells, right? Think about the random walk theory. Madoff rarely had a negative month, only 7 in over 14 years. And that kind of consistency, based on the random walk theory, is somewhere between suspicious and completely impossible.
It's a proprietary strategy. I can't go into it in great detail.
Also think about risk and reward. Madoff never lost more than 0.55% during his negative months, and he never posted back-to-back negative months. There was seemingly no trade-off between performance and downside protection. His investors got both high returns and low risk. Seem a little bit fishy? Financial markets are large, complex, and ultimately beneficial if you can be patient and master your own self-destructive urges. Finally, lesson number 4, beware the effects of modern society. Madoff's was a new version of an old scheme, but clearly we haven't learned better since Ponzi lent his name to the scam over a century ago. Consider attention fragmentation. It's where your brain is drawn in 1,000 different directions at one time. And then think about Kevin Bacon. Between 2000 and 2007, Kevin Bacon starred in 16 movies and directed and produced 4 other projects. That's very Bacon-esque. Like the rest of us, he had a few other things going on, which raised the potential for error with his finances. And boy, did he end up paying the price. How about informational reflexivity? Otherwise knowledgeable authorities, such as fund managers, suspected Madoff was subsidizing their performance to pad his numbers. Yet they continued to invest with him. Why? Because informational reflexivity says that experts take their cues from other experts. Finally, biased information processing. Madoff promised 12 to 20% returns for his clients no matter how the market moved. And investors believed he was delivering on his promise because they wanted to.
Jailbird, jailbird, end up chipping rocks. Jailbird, jailbird, you got a bit surprised.